Hello friends, welcome back to my channel. Please like, subscribe and also press the bell icon. So my next recommendation is actually KNR Construction Limited. In this video we are going to discuss why I feel that this is undervalued, and I also ask you to uh, slowly accumulate this stock if you're convinced about this story. So KNR Constructions, actually this is already existing from 1995. They are actually in the infrastructure related company. So they are managing actually EPC services in the roads and highways, irrigation and urban water infrastructure. So as you can see here, I think they also given the details here. They already delivered 79 infrastructure projects across 11 states. There are also this toll management and other things, BOTR, HEM portfolio also they've got. They also, they constructed the roads, and they also got equipments, 394 excavators they've got, tippers they've got, and 302 generators and other equipments they've got. So in terms of segment wise, roads they are into 46%, 26% into irrigation, pipeline 28%. State wise, as you can see, this company is from Andhra. I think 71% is from Andhra, they are doing the business, and Karnataka 13%, and Kerala 11%, and Tamil Nadu 5%. So this is the company's details. You can also check, Google it, what is EPC service provider and all those things. Just come to the pricing related part, or the some ratios, financial ratios, or the analytical part. So this is actually a 4,000 crore market cap company. Current price is 145. So this is actually kind of a 52-week low, and P values, this is very attractive, 5.93. And just if you are looking at the P ratio, price to earning ratio, that means what is the current price and what is the earnings EPS. If you divide that, that is comes to P ratio. That will not give you any indication. So that means you need to, till now whatever was the earnings per share was there and price is there, they will just divide it, I think. But you don't know what is the future. That's why if you're just investing based on the PE, it is not a good indicator. That's why you should also combine the PE and PEG ratio. It's called price to earnings and growth ratio. I can also show you here. PEG ratio is 0.13. That means if you divide price to earnings ratio divided by growth, what is the percentage you get? So that is what it gives. For example, in this case, I think P ratio is 6 or something, and growth is, even if you consider 10, it will be 0.6. I think it is coming almost like 25% growth is coming up in this. That's why if you combine this PEG ratio and P ratio, for me this is very undervalued. Of course you don't need to accumulate all at once. So you need to divide the amount into 5 splits. For example, if you want to invest 1 lakh, divide it into 5 parts, 20,000, 20,000, 20,000. So you can start accumulating now, and you can see the quarterly result. If the quarterly result is good, then you can also kind of keep on accumulating more like that. So it's also very important that in the share markets you need to survive. You should always remember the Warren Buffett rule number 1 and rule number 2. So rule number 1 is never lose the money, never lose your capital, and rule number 2 is don't forget the rule number 1. That means ultimately you should never lose the money if you want to save and survive in share market. So returns, it doesn't matter. I think sometimes it will come, sometimes it will be less return, sometimes it will be negative unless you sell it. So to survive and to learning, keep on learning, this is very important. So I think in terms of the both stock PE, this is really less than 10 means it's very undervalued, and PEG ratio is also good. I think if it is less than 1, then it is good. It's always more than 0 and less than 1. Whatever, if it is towards 0, then it's really good price. This 0.13 is really good. Even you can see ROCE and ROE, they are really good. Returns on the capital employed and the returns on equity, both are good. Face values too, and promoter holding is actually 48, and dividend payout is very less anyway. It's negligible, 0.17. Debt to equity is also, I think, reasonable. It's 0.49. You should always look at the companies where the price to earnings, price to debt to equity ratio is less than 1. That means they should not overpay the interest rate, and which can also cause a problem to the company. They also got a reserves of 4,700 crores, you can see here. So the market cap is 4,000. That means this is a no-brainer. They have got enough cash here, and I think currently I think the market is giving less price than the cash what they've got. I think one reason is also the market is keep on falling from couple of days, and that could be also one reason. And even particularly small cap and mid cap they are correcting a lot. You can see here itself, I think the 52-week high price is 332. So this is almost like reduced by 50%, more than 50%. Yeah, another thing is the market cap is also reasonable with one time, and price to book is also reasonable. So chart wise, if you see, it is on a downtrend. So this is also kind of a double edged sword actually. So if it is going down, you should also try to find out what could be the reason, but I don't see any reason. I'll also give you another reason why you need to accumulate. That is actually mutual fund also started buying it. So you are not overpaying here. So if you start accumulating slowly, definitely you will, chances of making money is more. I mean, losing the money is very less unless overpay to some company. Then the chances of losing the money or it's consolidating is actually consolidating for a long time will be there. But in this case, if you are paying less price and the reasonable price, in case if the turnaround happens, so this can really give you good appreciation. You can also see here the profit growth is also 32% high. Somehow I think, not sure why exactly, maybe the sales is less, that's why, or something. This company is not getting a good rating actually. So but I think you can accumulate slowly, as I said. So you can see, yeah, maybe the sales is less, that could be the reason. I think last year sales was good, and I think this year it's very less. Maybe that's also one reason. I think sales wise, I think 10 years it's really good, 18%, even 5 years is good. But actually last year this is very less. I think that is also one reason. In terms of the cash what they've got, reserves 4,700. So here they also got borrowings, I think debt, but still it is 0.49 is the debt to equity ratio. That's not so much alarming. You can ignore it, because if it is then this construction business always the payment and other things will come later. That's why they have to invest in the beginning. Maybe the working capital and other things, they will always have a loan. So why, another important thing is, you can see here, I think DIA has also exited, but there are also new entries, you can see here. So one new entry is ICICI Prudential Infrastructure Fund. So they have actually added almost like 4.3 in the December quarter. So if the mutual fund house is actually entering, means you can think of so you can think of it as for a long term. But they are also reducing here, HDFC mutual fund, not sure what is the reason. But one thing is, I mean, that's also mixed. Some of them are entering, some of them are going out. There could be multiple reasons, but somebody is entering means it's also good news. I think if they have entered, means they would have done a thorough analysis. So a lot of companies also exited. Maybe they exited at the higher prices. Here also another entry is actually HSBC mutual fund. They also entered. Then Axis Bank is continuing to hold 1.38. So another new entrant is also Bajaj Finance Small Cap Fund. So yeah, I think it's because of this mutual fund exit, maybe the price would have come down. But however, I think you need to look at the growth percentage, PEG ratio, and the PE value, as I said. So this is actually kind of undervalued. You can start accumulating, but I'm not a SEBI registered financial advisor. Please also do your own analysis before buying or selling. This is not a buy or sell recommendation. Thanks for now. Bye.